Right now, somewhere in America, there's a couple sitting at the kitchen table, both employed, both pulling in decent money, and they're absolutely terrified to touch a single dollar. They've seen the headlines: recession coming, prices surge, Goldman raises recession odds, and instead of making a move, they're frozen, paralyzed between spending and saving, between investing and hoarding cash under the mattress. They want to do something smart, but every option feels like the wrong one. Sound familiar? Here's the thing. That fear, it's completely understandable, but it's also the most expensive thing you can do with your money. Because while you're frozen, inflation is quietly eating your savings, your debt is quietly compounding, and the market is quietly discounting your future returns. Doing nothing is still a decision, and historically, it's the worst one. So today, we're not going to panic. We're going to build the exact recession playbook that normal middle-class families need before the storm hits, not during it. 4 priorities in the exact order you should tackle them. Let's go. First, let's actually define what we're dealing with, because most people are terrified of a word they've never actually looked up. A recession is technically 2 consecutive quarters of negative GDP growth. That's it. It's not the apocalypse. It typically comes with job losses, tightening credit, and a general slowdown in economic activity. But here's a stat that should immediately calm you down. Since World War II, the average U.S. recession has lasted just 10 months. Meanwhile, the average economic expansion has lasted 57 months. So for every 1 bad month, you've historically gotten nearly 6 good ones in return. Recessions are temporary. They always have been. And right now, in early 2026, recession fears are very real. Moody's Analytics puts the risk of a 2026 recession at 42%. Goldman Sachs recently bumped their 12-month recession odds to 25%. Consumer debt delinquencies are rising across credit cards, auto loans, and more. Middle-class households are feeling squeezed from every direction: high prices, stubborn inflation, and a job market that feels tighter than the headlines suggest. Deloitte's consumer products leader has even said, and I'm quoting here, "The bottom half of the economy is already in recession to some extent." So this conversation isn't fear-mongering, it's preparation. There's a massive difference. Priority 1, liquidity. Build your recession buffer before you touch your investments, before you think about your debt, before you do anything else on this list. You need cash, not stored in crypto, not locked in a brokerage account. Liquid, accessible cash sitting in a high-yield savings account. The standard rule you've always heard is 3 to 6 months of expenses. That's your baseline. If you're a single-income household with kids and a mortgage, you want to push that towards 6 months minimum, ideally 12. Why? Because during the Great Recession, the median period of unemployment extended well beyond 6 months for millions of Americans. 6 months sounds like a lot until it's month 7, and you're still sending out resumes. Here's how to think about building this buffer without it feeling overwhelming. Start with $1,000 as a psychological first step. Just $1,000 sitting in a high-yield savings account, completely separate from your checking, separate from your fun money. That's your first firewall. From there, automate a fixed transfer every payday. $50, $100. Whatever the number is, make it automatic. Don't try to remember to save. That strategy has failed every human being who has ever tried it. Now, here's a concept that doesn't get talked about enough in these videos. It's called sequence risk, and it's why the timing of your cash cushion matters more than people realize. Sequence risk is the danger of a near-term decline in your assets forcing you to sell at exactly the wrong moment. If you lose your job right when the market is down 30% and you have no cash buffer, you're forced to liquidate investments at their worst possible price. You don't just lose once, you lose twice. First on the decline, then by missing the recovery. A proper cash cushion is the thing that keeps you from ever being in that position. It's not just savings, it's insurance against being forced to make a terrible financial decision at the worst possible time. Priority 2, defensive debt moves. Once your liquidity is sorted, the next thing on your recession playbook is attacking your debt, specifically your high-interest debt, before the environment gets worse. Here's why this is urgent right now. Interest rates have been elevated. High interest debt, credit cards averaging anywhere from 20% to 29%. APR, personal loans, car loans, these are money furnaces in a recession. You're essentially paying a guaranteed 20% plus fee every single year to carry that balance. No investment in the world reliably beats a guaranteed 20% return. Paying off that debt is your best investment, or refinancing is your tool here. Debt refinancing simply means replacing your existing high-interest debt with a new loan that has better terms, a lower interest rate, lower monthly payment, or both. For example, if you're carrying $30,000 on credit cards at 24% interest, that's $7,200 a year in interest alone, roughly $600 a month, every single month just to stay in place. Refinancing that into a personal loan at 10% cuts your interest cost by more than half. That's hundreds of dollars freed up every month, money you can redirect straight to your recession buffer. The second part of the defensive debt strategy is just as important. Stop adding new fixed costs. Recessions are not the time to upgrade your car, not the time to take on a new lease on a bigger apartment, not the time to co-sign on anything. Every new fixed monthly obligation you add right now is a chain around your cash flow. Flexibility is your most valuable asset going into economic uncertainty. Guard it aggressively. If you're a homeowner and you haven't explored refinancing your mortgage recently, do it. Even shaving a full percentage point off your rate on a $300,000 mortgage can save you over $50,000 across the life of the loan and meaningfully reduce your monthly payment right now, when every single dollar counts. Priority 3. Recession-proof your income. Here's what most personal finance content completely skips over in the recession conversation. The single biggest financial risk most Americans face in a downturn isn't their portfolio, it's their job. Unemployment goes up in recessions. That's not a surprise. What is a surprise to most people is how long it takes to find a new job once you've lost one, which means the best recession hedge isn't in your brokerage account, it's in your skill set and your income diversification. Let's talk skills first. Not all skills are created equal when budgets get cut. Companies in a recession slash cost, but they protect the things that directly make money or save money. Sales skills, data analytics, digital marketing with measurable ROI, cybersecurity, finance, and compliance, these are the roles that get protected. The common thread? Measurable business impact. If you can clearly point to how you directly made the company money or saved the company money, your seat at the table is much more secure. So what should you be doing right now? Take honest inventory of your skill set and ask yourself, if my company had to cut 20% of its workforce today, am I in the protected category or the vulnerable one? If you're not sure, that's your answer. Start learning. Platforms like Coursera, LinkedIn Learning, and EDX have certifications in exactly these areas. A few hours a week now could be the difference between employed and unemployed in a downturn. The second half of this priority is income diversification. The families that weather recessions best are not the ones with the highest single salary. They're the ones with multiple streams of income, freelance work in your field, a side consulting gig, digital products, teaching a skill online. Even a few $100 extra a month from a secondary source provides a financial and psychological cushion that's hard to overstate. If your primary income gets cut or eliminated, that second stream doesn't replace it, but it buys you time. And in a recession, time is everything. Think about it this way. A family with a $90,000 salary and zero other income has exactly 1 point of failure. A family with $70,000 in salary, $800 a month in freelance income, and $500 a month from a small online business has 3 layers of protection. They might earn less in a good year, but they're far more likely to still be standing at the end of a bad one. Priority 4. Don't stop investing. Automate so you don't feel it. Okay, here's where a lot of people are going to push back. The economy is uncertain. There might be a recession, and you're telling me to keep putting money in the market? Yes, absolutely, unequivocally yes. And here's the data that should convince you. Since 1929, the S&P 500 has gone through 13 bear markets, roughly one every 7 years. The median price decline during those bear markets was 34%. Sounds terrifying, right? But here's the other side of that coin. 1 year after each of the 10 worst single-day drops in S&P 500 history, the market posted double-digit positive returns in all but one instance. And using nearly 100 years of U.S. stock market data, there has never been a 20-year period where the stock market lost money in inflation-adjusted terms. Not one, not the Great Depression, not the dot-com crash, not 2008, never. So what do you think happens to someone who panics and sells in a downturn? They lock in real losses. Then they sit on the sidelines, waiting for a feeling of safety, which always arrives well after the recovery has already happened. By the time they buy back in, they're paying higher prices than what they sold at. They lose on the way down and miss the recovery. The data is brutal and consistent. Investors who try to time the market almost always destroy their own returns. The best strategy isn't smarter market timing, it's removing the decision entirely. This is what dollar cost averaging is, the concept Benjamin Graham introduced back in 1949 in The Intelligent Investor. You invest a fixed dollar amount on a fixed schedule, regardless of what the market is doing. When the market is down, your fixed amount buys more shares. When the market is up, it buys fewer. Over time, this naturally lowers your average purchase price and removes emotion from the equation entirely. Ramit Sethi, one of the most practical voices in personal finance, puts it plainly. Success lies in consistently saving and investing every month automatically. He barely checks his account. The news doesn't change his decisions, and that approach, boring as it sounds, has made ordinary people wealthy over decades. Wealthy people don't have secret investments. They put more money into boring index funds, consistently, automatically. That's the whole game. Set it up once. Automate your 401k contributions so they never touch your checking account. Set up automatic transfers to your Roth IRA on the first of every month. If a recession hits and the market drops 30%, your automated contributions are now buying 30% more shares for the same dollar amount. That's not a crisis, that's a discount. The investors who come out of every recession ahead are the ones who treated the downturn as a sale, not a catastrophe. Here's what nobody is going to tell you. You cannot control whether a recession happens. You cannot control if your company does layoffs. You cannot control what the Fed does with interest rates or what happens to oil prices halfway around the world. None of that is in your hands. But your cash buffer, absolutely yours. Your decision to kill high-interest debt before it kills you, yours. Your investment in the skills that keep you employed when others are being let go, yours. Your automated contributions that buy shares at a discount while everyone else is running scared, yours. The middle class doesn't lose in recessions because the economy is unfair. They lose because they freeze, they wait, they panic, and by the time they decide to act, the window has already closed. You don't need to predict the future. You just need to control your margin and your behavior. Build the buffer, kill the expensive debt, lock in your skills, automate your investments, and stop staring at the ticker. That's the entire playbook. So tell me, which of these 4 priorities feels most urgent for you right now? Are you starting from zero on the emergency fund? Drowning in credit card interest? Worried your job skills are getting stale? Drop your situation in the comments. Seriously. You'd be surprised how many people watching this are in the exact same spot, and this community is full of people who've already figured a way out. If this gave you some clarity, hit that like button. It takes 1 second and it helps this reach more families who are sitting at that same kitchen table, scared and stuck. Share it with someone in your life who's been putting this off. And if you're not subscribed yet, now is the time, because recessions don't send advance notice, but will make sure you're always ready. The economy doesn't wait, and neither should you.